Hi, Eric. How are you?
Morning, Ed. I'm good. How you doing?
Good. Sunny and chilly here in New York. How's the fire situation in your neighborhood?
We got some rain, a couple days of rain, so
Okay.
hopefully looking up.
So I got to turn this thing off. So now it's the issue is mudslides.
Yeah, there's always something really.
Yeah. You should move back to New York. It's very calm here. We got a lot to talk about. Max is very excited again. Looking forward to our conversation. Deep Six is all over the media. We we kind of did the same thing, jumped all over it with this on Sunday with our quick takes as well as with the morning briefing. Let's just have a little discussion about what you think, what I think about Deep Six. In my opinion, it is an important development. It's an evolutionary development where in the digital revolution that started in the 1950s, and the digital revolution is actually pretty straightforward. It's all about data processing. The whole name of the game here is to process as much data as we possibly can, as cheaply as possible, as quickly as possible. And so we went from the IBM mainframe in the 50s. Then I guess it was in the 1990s, we had the digital, 1980s, 1990s, we had the digital mini computers. Then came PCs and laptops, the cloud, and now AI. And AI just allows us to do exactly what this revolution is all about, process an enormous amount of data very, very quickly and come to conclusions. And there's so much available now that we have to actually design large language programs to models to help us interpret what the data uh, implies and come to some conclusions. So it's pretty exciting stuff. And what Deep Six demonstrated is that maybe the American AI companies are spending too much money on infrastructure. Maybe we don't need the top of the line NVIDIA chips, and maybe we can find ways of cutting costs in terms of training these models. Whatever, I think it's a good kick in the butt to the AI industry to try to find cheaper, more efficient ways of delivering all this AI technology. And competition at the end of the day is great for consumers. It means that you and I, our companies, will get access to AI models that are cheaper to access, will be more powerful, and they'll be incorporated into other technologies like humanoids and robotics, automation, drones, and so on. Obviously, these can all have adverse, even evil consequences, but it's for man and womankind to do the best we can with this new technology. Just the way I guess we dealt with fire and not so well with nuclear weapons. But let's. I don't want to get too philosophical. Too philosophical. What's your spin, Eric, on this all? Should we be selling Nvidia and all the AI stocks and so on?
Yeah, I mean, there is a big question mark if they can really, or if the Mag 7 can prove the ROI on some of those big projects. But at the end of the day, I don't feel like the spending on energy and data centers is necessarily wrong. It's kind of stuff we'll need anyway. And who really knows how how cheaply or how few chips DeepSeek really had, just because they report, they didn't have a lot of really good chips or NVIDIA chips because there's a ban on exports to China. That doesn't mean they didn't have them per se. So yeah, I mean, it's on the Mag 7 to prove that spending makes sense, but they're also beneficiaries to some extent.
Yeah.
If they can figure out cheaper AI, they can cut their own costs. They're big users of AI. And then, it's not like AI has been fully integrated into every company and every consumer, the 493, let alone small businesses. So if we can get cheaper AI, it's a positive. It's good for productivity. It's good for lower costs. It's good for disinflation. So it's like a little bit of bad news, right? Because we've been spending a lot, but overall, it should be good news, I think.
Yeah. The title of our morning briefing today is tentatively the title is Gray Swan. It's not a black swan, and black swans I think are misunderstood. Black swans are just complete surprise events that nobody anticipated. They don't have to be negative; they can be positive. Uh, but gray swan just gets to the nuance that there's good things and bad things in this thing, and the bad thing is some of the stocks that people own today are down as they sort of get re-rated on rethinking how much is actually going to be spent on this technology, and whether Nvidia suddenly isn't going to be making as much money. I mean, if we can run AI systems with cheaper versions of NVIDIA chips, less sophisticated versions than the state of the art, they have lower margins. But on the other hand, NVIDIA is still going to be selling a lot of these cheaper chips. And then they got some pretty extraordinary margins on the state of the art stuff, and so it'll put downward pressure on their state of the art stuff. So it's all consistent with the way technology has always worked. It's always been deflationary. It's always been, you come up with a next new thing, you get a really high margin on it for a while. But one of the reasons the margin comes down is because you know that you have to work on the next generation of the new thing, or else somebody else is going to catch up with you. So technology is, it's it's what Joseph Schumpeter called this creative destruction. They eat their young. I mean, as soon as they produce something that's really exciting, before he really gets to hang around for a long time, they come up with another version. I think what's different this time around is that it kind of raises the possibility that you don't have to buy the new version because the old version is actually pretty good. And then, of course, that puts downward pressure on the margin for the new
Mhm.
version.
I mean,
But
there's some
go ahead.
there's also the argument of like reshoring, right? And this is kind of a national security issue. So the Stargate project, right, is like $500 billion, which is a crazy sum to think about. But if the government cares about it and it's a national security concern, and now we feel like we need to compete with China because they're also in this AI
Yeah.
race, then might be okay if you get some government support there.
That's true, but I also kind of question this whole Stargate idea of just throwing out big round numbers. We're going to start out with 100 billion, and wasn't that kind of the sum that the fellow from Japan came up with that he was going to invest? So suddenly he's going to invest the entire sum in Stargate, and then now and they said, all right, and we'll spend 100, and then oh yeah, and then eventually we'll spend 500 billion. I mean, they don't know what it's going to cost, and they don't know. I mean, Elon Musk got really annoyed and said, you guys don't even have that kind of money, and he's in competition with Altman, so he doesn't like him. Trump said they don't like each other. Uh, so there's a little personality tiff going on in this gigantic AI race. But all in all, I think it's a positive. It's a positive for the S&P 493.
Mhm.
Presumably, they'll be able to get cheaper AI, and I think you're right. There will be national security interests. I kind of doubt that American companies will or will be allowed to hand over all their data to China models made in China and use them just because they're cheaper and more efficient. But all the more reason that it'll put pressure on our companies to match the price, the performance, and the whole thing. So, I'm kind of encouraged with the way the stock market's trading. I think it's okay. Maybe this is a good way to get rid of some of the AI hype, which would be a healthy thing. But I don't view this as kind of the tech bubble that we had in the late 1990s. That all of a sudden it's burst and it's go down. By the way, I mean the tech bubble. I was around back then, and in the late 1990s, I had a lot of conversations. I think I was at Deutsche Bank, and I had a lot of conversations with the junk bond strategists because what was really happening in the late 1990s is telecommunications companies were seller financing, and to do that, they issued a lot of junk bonds, and that's where the speculative bubble really was. It was in the junk bonds of telecom companies doing seller financing, and so it was very much a credit phenomenon when that burst. That whole market imploded, and then obviously dot comes and all that came down. But that was very much a credit event. This time around, I don't see any credit event that's unleashed by deep sixing some of the you know most expensive projects that companies have been talking about. So that's just a little bit of background history and comparison to then and now. Anything else you want to talk about on Deep Six, or you want to move on?
Now let's jump in.
Why don't we get into your favorite topic, since you're wearing a Federal Reserve sweater from your good old days on the trading desk? What do you think the Fed's going to do? Agree with everybody else?
Yeah, I mean, it kind of just depends what the rhetoric is. They'll pause, and I think it's interesting that Waller's been so, stuck in his rate cut mode, despite the fact that a lot more participants are feeling emboldened to speak more hawkishly, out in public. So we'll see. I think it'll be interesting to see what the Fed speak is afterwards. Obviously, there's no summary of economic projections, but they'll probably hold, and then the ECB will probably cut the following day. So I think that might be a bigger story, the kind of the diverging paths for the European economy and the U.S. economy.
That should firm up the dollar, right?
Mm-hmm.
Yeah.
Yeah, I mean, I don't know how much it might just be baked in, but Europe has kind of the same sticky services inflation that we do, but they have no growth. So I don't know. That's kind of it's a tougher line to walk.
And in terms of the economic calendar ahead here, anything strike you as something we need to be aware of or might surprise us?
No, I mean, we have sentiment, we have some manufacturing indicators. We think they might look good. We've been kind of waiting for the ISM, national PMI to turn up in Q1. So it might happen, in January, might be a couple more months. But there seems to be, at least in Philly, for instance, the enthusiasm is pretty high. And then we'll get personal income on Friday and the PCED inflation rate. I think, we had kind of hot or warm CPI and PPI, but the core services rates looked pretty good, or super core looked pretty good. So I think Fed officials will be encouraged by that. And I'm sure Waller and Powell will say, hey, we're getting disinflation where it matters.
The consumer confidence survey comes out, what day is it, a Tuesday?
Yeah, I think Tuesday.
Yeah, I mean, I like looking at that survey and the employment indicators to see whether jobs plentiful remains high, because obviously that's been an issue with regards to Fed policies. Is the labor market weakening? And recent data says that it's not weakening. Initial claims are still very low. So economy looks good. Inflation looks okay, a little sticky above 2%. Bond market looks like it's kind of where it should be, 4.5%. Stock market, if it's having a bit of if you're taking some of the air out of the AI hype, that's a good thing. It's certainly a good thing for the S&P 493. The Mag 7, I always consider the Mag 7 as spending an enormous amount of money without any immediate return on that, other than $20 a month or whatever they're charging for some of these cockamamie, models that are okay, but they're more toys than they're anything serious. But all in all, still nothing's changing in terms of our target for the end of the year for the S&P 500, 7,000. I'm thinking that the bond yield at the 4.5% plus minus 25 basis points is kind of where it should be. That the dollar is not going down; it's flat to up in our opinion, and so on. So let's share the charts here and see where they take us. Yep. Okay. So today is January 27th. We sent out an advanced copy last night for those of you who like to get to be put to sleep by our research. So Eric, we're kind of looking at the anatomy of the bull market. So we started writing this, and then along the way realized that the big story was actually Deep Six. Deep, do that again. Deep Six, Seek. It's a tongue twister trying to say that 10 times. But anyways, this is a chart on a ratio scale that shows the S&P 500, the forward earnings of the S&P 500, and the forward PE of the S&P 500. And if you go back to October 12th of 2022, you find that earnings have gone up since then at a kind of a teen rate. I think it's about 17% since the beginning of the bull market. But the bull market, we've got like a 70% increase and the S&P 500. So clearly the bulk of the bull market has been led by valuation. And here we are at a forward PE of 22.3, at least for the January 24th date, not for today's date. And where does the market go from here? Well, our thinking is the valuation multiples probably not going to go higher. We're not dismissing the possibility of a melt up. It's still one of our scenarios at a 25% probability. But the roaring 2020 scenario with a 55% probability is the market continues to go up. But this time it's increasingly led by earnings and not by the valuation multiple. And again, from the perspective that kind of outlook, that we're kind of comfortable with what's going on in the market. Having people less willing to pay even higher PEs is a good thing. I obviously don't. I'm not rooting for PEs to take a dive, but we're not rooting for PEs to go straight up from here. So this is just a look at 2024, and there was a much more even Steven relationship between the forward earnings and the forward PE. This is year-to-date percent change. So it's the beginning of 2024 to now, and you can see we had like a 23% increase in the S&P 500, and about 12% of that was the forward earnings, and almost 10% of the rest of it was the forward PE. So that was more even, and now we're thinking it's going to be uneven with earnings leading the way, and we're talking about $285 a share for the S&P 500. So that's that number right there. I think we're still at the high ones on the street for earnings. Bloomberg came out with the latest poll of about 22 strategists. We're not out on there. I try to get on there, but they said it's a legacy thing. They're trying to keep the same sample. So I said, fine. So we're always comparing ourselves to that, and we're at the high end of the street. And this is what it looks like on a ratio scale, which has a pretty steep slope in terms of last year, this year, and 2026. But it's not out of the realm of possibilities, and certainly consistent with the roaring 2020s scenario that we've been talking about. When we do PE times E, we do forward PE times forward E. And so based on our thinking about what actual earnings are going to do, we're projecting that forward earnings at the end of this year will be what analysts think earnings are going to do in 2026. So at the end of 2024, we figured they were looking at 275, which is pretty much what that number was for forward earnings. Then we're looking at 320, and then 360 is where analysts are going to be thinking earnings will be at the end of this year and then at the end of next year. So at the end of 2026, that'll be relevant for thinking about 2027. At any rate, we got some pushback, Eric, on revenues. I don't know why I have to constantly figure out how to. There we are. I think it's usually whoever's talking gets to be shown on the right side, but this way we're both on there. But Eric, what's your thinking? What's our thinking on revenues growth? I mean, we're looking for revenues to grow about 4% this year and next year, and the pushback has been that Europe's looking kind of lousy and China's looking kind of lousy. Any thoughts you want to pass along?
Yeah, I mean, if we're kind of studying out from the pandemic, I think it makes sense to, wherever our growth, our economic US GDP projection is, for that to line up. And sure, a lot of these companies have a lot of offshore revenues. But I think, the laggards, so to speak, have been the companies that are more domestically tuned, right? So they've been the ones underperforming. So yeah, 4 or 5%, I think makes sense. Even if Europe is in a little bit of a rift or a rut, they're easing monetary policy, and I think demand should be fine. So I think our revenues projection is fine.
Yeah, I mean, Larry Fink is the outlier, the contrarian on Europe. He thinks they're bottoming and they're going to do better. I find that a little bit hard to believe, but that's Larry. Nice to see he's an optimist. But with regards to the revenues, this is the average growth rate of S&P 500 revenues, and it's 4.3%. And I would just point out, and we pointed out, that we're assuming no recession over the next couple of years. So that average obviously has been weighed down by previous periods when there were recessions. I guess we should make a mental note to look at what that average is, excluding the recessions. And I mean, clearly it's going to be something over 5%. So, looking for 4% this year, next year is, I think, kind of reasonable. Then we're looking at forward PE, the forward earnings. We get that on a weekly basis. So it's a good way to just get a weekly coincident indicator for actual revenues. So actual revenues is blue, and as you can see, it went to an all-time record high in the second quarter, in the third quarter, fourth quarter, it'll make another record high, and the forward earnings series confirms that. Then what are the implications of all this for the profit margin? And consistent with the Roaring 2020s idea, we have the profit margin rising to the new record highs. The analysts are kind of not as optimistic as we are. And usually they tend to be more optimistic than strategists. But I don't know, then you and I had happy childhoods, so that justifies happier profit margins. This is the profit margin again versus forward profit margin. Uh, it's kind of at a record high. It's back to its previous record high, and we think it's going to go higher, confirming that the actual profit margin is going higher. Eric, what about this pushback we get about, well, wait a second, how's profit margin going to go up when interest expense is going higher? I think you found this series not too long ago.
Yeah, I mean, interest rates went up, but for the average corporation or for the S&P 500 and definitely the Mag 7, they went down. Interest expense was basically all their debt was termed out during the pandemic. They got low rates for a pretty long time, and then all the cash on their balance sheet was earning, 4, 5, 5.5%. So they were actually deriving net income. So in terms of profits, like net interest, it's pretty marginal for a lot of these companies. And it's not just, I think a lot of people talk about like Microsoft's cash balance and Apple, and they can make a lot in money market funds doing nothing. But I mean, like, even a few months ago, Uber was raising long-term debt at pretty low rates. And like now, US Treasury yields are nearly at where they are raising debt. So I don't think this is like a big issue. And even in the higher for longer scenario, I don't think it eventually like takes out corporate profits and weighs on, bottom lines.
Yeah, and you did make a good point that it's net interest paid, so presumably it offsets whatever interest they're earning on their assets, their money market, their liquidity, or whatever they have. And this thing is probably a lagging indicator, so it is going to reflect higher interest rates, but it's so low that it's just hard to really worry about it. And if it takes its sweet time, kind of going back up along the way, we could have more productivity. We could have a tax cut from 21 to 15%. That'll probably increase the profit margin on a one-time basis by about 50 basis points. So right now, it's just not really an issue for us. Meanwhile, the economy continues to do well. This is coincident indicators, which is probably the best way to look at a monthly proxy for real GDP. And it's highly correlated, or forward earnings of the S&P 500 is highly correlated with it. And it is interesting to see that forward earnings are doing so well when the rest of the world isn't all that red hot. And we know that 40 to 50% of earnings of the S&P 500 earnings come from overseas. And Eric and I kind of concocted this chart as a proxy way to think about the U.S. versus the rest of the world. This is S&P 500 forward earnings, all-time record high, nice steep slope. And this is S&P 500 air freight and logistics. So FedEx is in there, and UPS and so on. And it's fascinating that they correlated pretty well, suggesting that the global business cycles were sort of in sync, both to the upside and the downside. So there wasn't much informational difference between the two series. But now look at this. We've got the air freight forward earnings taking a dive here, and that's, I guess, ever since the end of the lockdowns. Really, it's really pandemic related, but Meanwhile, along the way here, I guess it goes back to 2022, and a lot of bad things happened to the global economy in 2022, like China fell into a property depression, and Russia invaded Ukraine, which really depressed the European economies as well when we had the war in the Middle East. And so the global economy, based on this measure, doesn't look like people are sending a lot of the FedEx packages to each other overseas. And meanwhile, this thing just keeps going red hot here. Um, then what do we have here? I think we can skip the rest here. We did a quick takes on the Mega Cap 7 and discussed Deep Six. I don't know why I keep saying Deep Six. Maybe I'm a pessimist at heart. Maybe it shows my real leanings here. But Eric, why don't we field some questions? We got two, one from Kevin and one from Cagdis. We'd welcome a few more if you're so inclined.
So this first one from Kevin. So if I understand correctly, your 2025 target assumes that the current market valuation multiple remains the same.
Yeah.
So if that's correct, what are the dynamics involved that makes us believe that multiples will hold?
Well, it's a good question. We've been, prior to DeepSeek, we were thinking that the Magnificent Seven would remain magnificent, that their multiple would remain around 30, that they would continue to be 30% of the market cap of the S&P 500. We don't like to react or overreact to a sudden change in sentiment and insights here, but it's possible that DeepSeek will lower the multiple of the Magnificent Seven. But as we said, I mean, Microsoft has a lot of products that they can, charge more for updates that include AI versions of them. AI is just kind of like a constant upgrade of their current hardware and software. Apple obviously hasn't quite gotten the AI experience to the point where people definitely want to upgrade to new AI enabled phones, but that's kind of what's coming. I don't think we would argue that the valuation multiple of Magnificent Seven necessarily takes a dive here. We think it can hold this kind of level because they are still amazing companies with a tremendous amount of cash, not a lot of debt, a tremendous ability to buy technologies that they can leverage up. But if we're wrong in we go from 30 to 25, let's say, on the multiple for the Magnificent Seven, we'd argue that we might be able to make that up on the other side with the 493. Right now, I guess, or last I looked, they were about 19 forward PE. Well, maybe they go to 2021 because everybody realizes that their profit margins are going up thanks to all the technologies out there. And it's not just AI, but lots of technologies that are working to increase profit margins. So yeah, we're going to stick with that valuation multiple, and obviously with our bullish outlook for earnings, that gets to 7,000 on the S&P 500 by year end, 8,000 by the end of next year, 10,000 by the end of the decade, 2029. Go ahead, Eric.
Yeah, I think also just another point, like a lot of these companies have pretty built-in relationships with like SMEs and their customers. Like if you use Microsoft, then you're using Microsoft. If you use Salesforce, which also is a big AI player and has these AI agents, like that is your business partner. So it's not like that everyone's in a free-for-all for these models. Most of it is like enterprise relationships. So it's something to be seen and maybe plays into that revenue story, but just anecdotal. From Ian, Ed, your thoughts on earnings per share gains and the stimulus for CapEx with a lower corporate tax rate, assuming that passes?
I think the question provides the answer, right? I mean, it seems to me that we're as we just went through, we're expecting the profit margin to go up. We're expecting revenues to increase at a normal rate. So you combine all that and you get strong earnings and profits. Profits are kind of a magic potion. I wrote a book a couple of years ago called "In Praise of Profits," and the basic idea is that Profits are like Rodney Dangerfield. They got no respect. The fact is, the economy is driven by profits. Profitable companies hire people, and profitable companies expand. And if the profitable companies can't find enough skilled labor, they will spend money on technology, on capital to augment the productivity of workers. And I think that's the kind of environment we're in. And we're just, we're taking it to the max with a roaring 2020s concept. Anything you want to add to that, Eric?
No.
Okay, go ahead. We'll take another one
All
or two.
right.
How
We'll take
about
the one from
Cactus?
Gus.
Yes, did we do Cactus?
Yeah, we got Cactus.
Okay.
Um, oh no, we didn't. Ed, how do you think the stock market trades around earnings this week? If they're weak, do we go down, or does the Nasdaq kind of fall further? If the results look good, does the market kind of just forget about this DeepSeek business and go higher? And then I think also this last point speaks to tech is a very crowded trade. Everyone's kind of in the Mag 7 at this point. Will strong earnings be kind of the release valve for people to degross?
Well, I think the conference calls with tech managements are going to be extremely important, extremely interesting to see how they push back against the DeepSeek news. And I think they're going to push back pretty hard and fairly successfully, and kind of make their case that their approach is the correct approach. But at the same time, I think some of them will be reasonable to say, this opened up an avenue for us to, provide the same kind of services, perhaps at a lower cost than we'd been thinking about. So it's kind of probably going to be, if they're honest about it, they're going to provide a mixed message on this. But I think any sell-off is a buying opportunity in a bull market, is the way we're looking at it. Bear markets are usually caused by recessions. We don't see that. Bear markets corrections are usually caused by concerns that a recession might occur, and then it doesn't occur, so it turns out to be a correction. I don't know that anybody's looking at what's going on now with in the AI world and saying, "Oh, this is going to lead to a recession. This is going to lead to a 2000 kind of meltdown." I mean, we don't see it. We could be missing something, but as I said, this whole brouhaha doesn't seem to be affecting anything in the credit system. So yeah, we think any sell-off is an opportunity. One more, Eric?
Sure. This one's from Gus. Ed, the weather impact will be reported in the upcoming data, and at the same time, we'll have lower inflation coming through from like new tenant rents. So do we expect rates to come in a bit or kind of hold in the trading range they've been in?
You want to take that, Eric?
Yeah, I think, we've had a lot of bouts of weather impacting employment reports. I think the fires will be pretty isolated with California initial claims. And if anything, lead to more construction employment here. So I don't think that's a huge issue, but yes, the Fed tends to react to downside labor market data. I think they'll be more attentive to, barring any unforeseen events in the labor market. I think the shelter CPI coming down and services inflation coming down will be pretty important for the Fed to at least signal that they're willing to cut rates later on. Any near term downside labor market stuff outside of California, I think they'd be a little quicker on the trigger.
Yeah, and I think now that Trump has kind of done a Ronald Reagan in effect and said, take down these interest rates. He didn't say Chairman Powell take down these interest rates the way Reagan said to Chairman Gorbachev take down this wall. But I don't think they're going to want to like knee-jerk respond to Trump, especially since they still don't know what Trump's going to do on the fiscal side.
Mhm.
So no, we're kind of comfortable with rates staying here for a while. So that's it. Eric, thanks for joining us as always, and thank you all for joining us as well. Have a good week.
Thanks, everyone.